Welcome to our first quarter 2025 webinar, Spending in Retirement. And as you know, this is a big part of our meetings with you, trying to lay out ways in which you have a good sense of where your money's coming from once you retire and that it's coming in on a regular basis. So I'm going to start out by talking about spending in retirement in terms of putting it in some context, because there are a lot of old ideas about how much money you should be using for retirement and all of that. And also people's concepts of retirement haven't indeed evolved and changed over time. Then Andrew is going to talk about some practical ideas with respect to managing your money in retirement and where you should put certain things. And then Bill Driver will talk about retirement income updates and some of that stuff. So I'm going to get started by first highlighting our team, which has grown, as you all see. And you'll recognize these four old white guys up here. That's me and Mike, Bill, and Scott. Scott is a new advisor. Scott came to us from John Hancock, was the team lead for 401k plans and retirement plan services for John Hancock in the Pacific Northwest and Alaska. And then there's Andrew. And then, of course, you all know Katie, who, by the way, is over in England this week on vacation. Emily, who's our analyst. Donna, who you know from being we call her our den mother, but she also does all of our events. Emmy Brown, who's a new addition to our team. We're thrilled to have her and is helping not only Donna, but also helping Andrew, who, in addition to being an advisor, is also our chief operating officer. And then Tim, you've probably seen Tim. Tim is our producer. And so you may or may not know, but Mike has been doing a radio show over in Spokane for 16 years. And this last year, we added 2 here in Seattle. So we have 3 radio shows. Tim is the person that does all of the pre-production, the editing, our social media, and is just a great friend and a great guy. Okay, so I'm going to start off with practical realities for retirement spending. I'm sorry, that's wrong. That's the wrong lead-in slide. So determining your retirement income spending budget. In the old days, first of all, in the old days, people had things called pensions, which has all but disappeared. I remember in my Stanford lectures talking about, of the Fortune 100 companies in 1985, 2 years after I got into the business, 85 of the 100 had pensions. In 2012, it was down to like 50, and then just a few years ago it was like 11. So what they used to say is whatever your last year's highest compensation, you should just assume that you'll spend 70%. Well, that's not really all that accurate. That's just a heuristic or a rule of thumb, and it's not all that useful. Our suggestion is that you use our retirement income analysis worksheet, which you can also use just to kind of get a sense of what your current budget is. And I will be showing you the slides on that in just a second. This is going to be very well familiar for all of you, but it is a critical thing. We think it's way more important to be as detailed as you possibly can be in looking at retirement income spending. Now, another mythology has to do with the idea that if you did the 70% highest year's compensation, that's the way it's always going to be. Well, that's not actually how it works. In fact, in the first few years, because now suddenly you're not working and you've got those bucket lists and you want to travel and go down to Australia, New Zealand for 2 months and then go to Europe and go around the world, the expenses actually go up. Then it wanes when maybe your appetite for travel declines and you want to be around your grandkids more, then you spend less time traveling, less money. And then, unfortunately, as I've said to you any number of times, it costs a lot of money to get sick and die in this country. So as you age and you have possible long-term care issues, medical issues, etc., those expenses go up. Andrew recently actually wrote a blog, which will be coming out here pretty quick, talking about spending in retirement and talking about this issue. It's really excellent. Talking about the old methodology was a 4% spending rate. Now it's probably closer to 3%. And then Bill is going to talk to you a little bit more about what we call our sustainable income ratio later in this presentation. So here is our retirement income worksheet. And you know, it in this section is basic expenses, and then down here is discretion. So this is the have tos, and this is the want tos. But really what we're after is getting as close as we can to an accurate figure. And this is something that we suggest that you fill out once a year, and then provide it to us in advance so we can make whatever adjustments may be coming up in terms of our assumptions and making sure that we have the income generating for you that you need. But the bottom line that we're looking for is how much money do you need from investments, net of Social Security, pension, employment, if that's something that you're doing, and other. Now, you might say, well, who's going to work after after they retire? Well, for example, often some of our high level of corporate executives decide they're going to consult for a while. So then they still have employment income. That what we're not saying is you're going to be a greeter at Walmart's or asking people at McDonald's if they want fries with that order. But that's basically the retirement income worksheet. Okay, so what are the major expenditures in retirement? So this is a survey back in 2013. I doubt it's changed much, but a lot of people think about home and mortgage costs, leisure and travel, household expenses, health and healthcare, and other. However, they forget taxes, and taxes is a very significant portion. So when we're forecasting your spending in retirement, we're going to pay attention to this as well. Now, often people say, well, I'm just going to delay retirement, and it's not a fail-proof backup plan because, as you can see, 49% of people retire earlier than planned. 38 about when they assumed that they would retire, 7 later than they planned, and 6 people, I don't know what unknown means, but there were 6 people out there, or 6% of the people that didn't have any idea. Well, what are the main reasons? Well, one is caring for a spouse or a family member. Another, 18% is job loss or downsizing, but 61% had to retire because of a health issue. So again, just giving you some context, being very focused about when you retire and why is important. And we really are at our best in working with people within 10, 12 years before they retire, because often we can bring this thing in line and be very productive about it. Now, one of the things that I was lucky enough to get exposed to and some behavioral finance advanced certification that I got was the MIT Age Lab. And it's a very interesting thing, but they were consulted by CVS pharmaceuticals, or, the pharmacies, because they were trying to figure out, well, why are products that are appropriate for elderly folks not going off the shelves? So what these guys did and came in and looked at a bunch of stores, and then they designed a suit that made the store managers hunch over, literally, and then had them walk through their shelves. And what they found out is that a lot of the stuff that was oriented for more elderly customers were way too high on the shelves to even see them. So they redid that and dramatically improved their situation. Then over the years, MIT has then done more and more and more work on life and retirement. And so that's what this program has done. And they came up with a couple of, kind of quick slides that I think are pretty interesting. The first is this was everybody's concept of what retirement used to be. And they were saying that's about 8,000 days in retirement. So, bicycle bill for two, travel, and playing golf. This is much more likely what they have found retirement actually to be: being around grandkids, reading the books that they always wanted to read, traveling around the country, dealing with their kids and grandkids, and, taking up painting or whatever. So it's a much more complicated story than this one. As a consequence, they have divided the stages of retirement into 4 chunks of 2,000 days. The honeymoon phase, the big decision phase, which has to do with where are we going to live, navigating longevity, because people are living longer, and Andrew's blog really talks about that too. So I encourage you, when we send that around to you, to spend some time to read it. It's really quite excellent. And then finally, the solo journey phase, which is how do you navigate having lost a spouse and now you're on your own. I know in my dad's case, my mom was 10 years younger, but she died in 2007. And then my dad died in 2015 at 104. So that last 8 years, he was on his own. So it's a very interesting thing that they have done, because they've now studied this in much greater detail. So the 4 phases of retirement are either some of the questions or decisions that people are saying. Well, shall I stay in my home? Or do I want to go to a 50-plus community? Do I want to move in with a family member? Do I want to upsize or downsize? Should I consider going into assisted living or continuing care retirement community? So these are some of the critical decisions that people should also keep in mind when you're looking at retirement. It's not just the spending, but these decisions will obviously affect the costs of your choices. Now, I know for a fact that a lot of people, when I do my lectures at Stanford, well, I used to do them in person, there'd be 80 people in the room, and I'd say, okay, how many people own a house? And everybody's hands go up. And I said, and how many of you want to be carried out boots first, meaning that they were going to die in their home? And of course, everybody raises their hands. And I'm saying, well, that's fine, but you may have to make some modifications. Now, there are some things that have changed. So, for example, okay, I'm not going to be able to drive. Well, now there's Uber. Well, I don't know that I can get to the grocery store. Well, now there's Instacart. There are people that you can come in, Angie's List, to do home maintenance and housekeeping and laundry. So there are more resources today than I would dare say even 5 or 10 years ago. And that makes things better, but they don't come without cost. But the last slide on this is pretty interesting. For those people that said, okay, I'm definitely going to want to age in my house, it's like, okay, well, that's fine. Is your house level? Do you live on one floor? Are your kitchen and bath counters at the right height if you were in a wheelchair? Where's your bedroom? Storage within easy reach? Are your appliances a comfortable height? You might have to get rid of doors in the house. Laboratory designs invite an open knee space, that kind of stuff. So there are all kinds of things that have to do with retirement and spending in retirement considerations beyond just the assumptions that we might make and say, oh, well, this is what it's costing me, in mortgage costs or whatever, to live the life as I now live it. Just recognize that if you make changes, then those changes have costs. So with that, now I'm going to turn it over to Andrew to talk about practical realities for retirement spending.
Thank you for that, Jim. Before I get started, because I was a history major in college, I am going to give just a quick little historical context to this kind of concept of longevity risk, which has always been around, but really has increased as time has gone by. Consider, if you will, that the first Social Security payment ever paid out by the Social Security Administration was paid out on January 31st, 1939. Jim, Bill, shot in the dark, do either of you happen to remember the name of the woman who collected the first Social Security check?
I wasn't around then, Andrew, so no. Okay. I mean, I know you think I'm really old, but no, I'm not that old.
It's all right. It's a fun and somewhat useful bit of trivia, but not a critical part to helping construct well diversified portfolios. The woman's name was Ida Mae Fuller, and she was a Vermont school teacher. Now, at the time in '39, when you were first eligible to collect on Social Security benefits, full retirement age, the age at which you would get your fair shake with no penalty for early withdrawals or bonus for waiting beyond that, was 65 years old, right? And Ida Mae Fuller turned her Social Security on at 65, and she lived to be 100, right? She was born in 1875, and she lived until 1975. And under the Reagan administration, when they first started doing the big increases, I think she got a letter eventually from either Reagan or President Ford congratulating her on her continued good health. So that was the environment back then. But back in '39, the average life expectancy in the United States for a man was 62.8 years, and for a woman, it was 65.4. So you basically had to have already outlived the average life expectancy to hit full retirement age as a man, or shortly there before as a woman back in '39. Today, full retirement age for those born before 1960 is 66 and 10 months. If you're born after 60, it's age 67. But the average life expectancy today in the United States is a little under 80 years old. I think it's 79.2, or it's something right along that line. So we know for a fact that Americans are living longer as a result of improvements in medicine and better health outcomes in our diets. But the key stat to bear in mind when we think about longevity risk is the population of centenarians, people who live to at least age 100, like Miss Ida Mae Fuller, is expected to quadruple in the United States over the next 30 years. Then we move to the next slide, please, Jim. So when we think about that longevity risk, that's the thing that we have to think about with your portfolio, because, right, Social Security, the checks are going to keep coming like they did for Miss Fuller. From a longevity standpoint, we have to worry about the pool of assets that you've built over your working lifetime. How do we make sure that that doesn't run out of money? Now, the conventional thinking around equities, and specifically portfolio construction, is once you move to retirement, you want to dramatically reduce the amount of equities in your portfolio. That old 4% rule that Jim was talking about was based off of a 50-50 split between stocks and bonds back when Bangwin first proposed it in '95, I want to say. But the reality about that, the new reality, is with a longer lifespan, we need to maintain a higher allocation to equities for a longer period of time in order to allow those assets to continue to grow to support you in your later years. Now, a key thing to think about that then is within a portfolio, and this is part of what we kick around the can on thinking about all day for each individual client, because no two are the same, is within someone's broad portfolio perspective, where can we locate assets that are poised for growth to try to be more tax efficient, specifically around, if we do have a higher allocation to equities, it probably makes sense for as long as we can to keep those in qualified retirement accounts, because as you may well remember, those are tax deferred. You don't pay capital gains tax on transactions occurring within those accounts. And to take it a step further, if we think about Roth as an option, either a Roth IRA or a Roth 401k, that's where we want to put the most aggressively geared things for growth, because not only will you not pay capital gains tax or investment income tax on bonds and other fixed income instruments, but when the money comes out of the Roth, it's going to come out completely tax-free. So that's partly kind of what we are putting into the stew, so to speak, as we're trying to mitigate and account for longevity risks. Now, obviously, a lot of people, when they get to the work optional phase of life and they hear, well, we want to maintain a higher exposure to equities than we traditionally have, people rightfully get a little bit anxious because, as I'm sure many of you have experienced in your time in the stock market, there are plenty of ups, but there's some pretty sharp downs as well. We always try to get people to remember the rule of 55, 65, and 75. And that basically holds that the market has been up 55% of all trading days, 65% of all trading months, and 75% of all trading years. And that data really does bear true back to 1928. Technically speaking, it's like 73.2% of years that the market's been up, but that's within a statistically acknowledgeable margin of error. This is the kind of the meat of it, is the longer we maintain that exposure to equities over a long period of time, especially as we get deeper and deeper into retirement or the work optional phase of life, the more likely it is that we're going to experience a probability of a positive return. Now, this doesn't net dictate the magnitude of those returns, but we do broadly have the confidence to be able to feather that in with sort of historical market assumptions and a variety of other instruments to give us an idea of what we can expect the growth assets to continue to get us. And then this is the big thing that we always try to get people to bear in mind, and it might be a little bit small on your screen, but basically what these blue bars are is what the market actually returned at the calendar year end. The orange is how much the totality of the bar below was how much at some point the market was down. And you'll see, right, 33 of the 43 years, the market was up. It was flat, exactly flat, one of those years, and then it was down about 25% of the time. So even in retirement, there are still these buying opportunities on an intra-year drawdown, those orange bars we're looking at there, where the market could be down 20%. And even though you're in retirement, we could say, it would make sense to put some more money into equities at this point, because when the market comes back, you'll have purchased at a discount. Now that said, just because we're going to maintain a higher exposure to equities for a longer period of time doesn't mean we're just going to do it without any sort of guardrail. So when we think about exposure to equities, it's no longer just having to go buy actual stocks or mutual funds or ETFs, and certainly not just an index fund or ETF. There are a variety of vehicles that we can utilize that help use buffers, floors, and a bunch of things I'm sure you've heard Bill and Jim talk about in your meetings with them to help build in some level of downside protection. The trade-off is they're going to cap your upside, but when you're at a point in life where your portfolio has already accrued significant value, we're less concerned about hitting home runs. We just need to keep stacking up base hits, especially while you're in retirement. So RILAs, I'm sure many of you have had conversations with Jim about those. Some of you might even own a RILA. Variable annuities with living benefit riders that will continue to provide income even if there's no money left in the account. Fixed index annuities, given the recent rate hike cycle that we've been through the last couple of years, those have become a much more attractive options. And then, as from a tax efficient equity side, there are things like those buffered exchange traded funds that I'm sure you've probably I think probably most people in this room have some exposure to those. IOVAs, investment only variable annuities to help accrue funds in that tax deferred environment for non-qualified money. And then, like I mentioned earlier, Roth 401ks, Roth IRAs, and rollovers as well to move potentially from a 401k plan to something that has greater investment freedom and the ability to purchase more of these buffered products that can help protect against your downside. This last one doesn't really provide downside protection. It actually provides downside opportunity, if you will, direct indexing, which is, shortly speaking, Jim, that's the next blog post I'm writing. I think that the draft is up on another screen right now. Essentially, direct indexing is, let's say we wanted to purchase an S&P 500 index fund. Rather than going and buying some ticker that replicates that fund, we would actually go and purchase a share of each of the underlying companies on the S&P 500. The rationale for doing that is we can now harvest tax losses for those companies as they move up and down based on their market performance. And under current tax law, realized capital losses can be used to offset realized capital gains. Also under current tax law, those losses, if you don't use them up in a given year, can be carried forward in perpetuity. So there is a way to kind of weaponize the volatility of the stock market as well to help control your taxation at a later date in time. Jim, back to you.
Okay. So yeah, just a final comment about direct indexing. It's a weird, it's sort of like an unnatural act. It's like, wait a minute, you're gonna put me into a managed account that's gonna give me the return of say the S&P to generate losses. Like what? But it's a perfect example. We've done this the last year or so, and we're going to be rolling this out more. But the benefit is that if I can still get the growth within plus or minus 1% of say the S&P, the Russell 1000, or more recently the Europe, Australasia, and Far East, the international index, and if it's up 20%, it's going to be up either 19 or 22 or 21. But we can also generate losses. Those losses can be used to offset gains in other parts of the portfolio. So it makes the entire portfolio that much more efficient. All right, well, so now speaking of retirement income planning, I'm going to turn it over to Bill. And Bill, take it away.
Take it away, he says. I will take it away, Jim. I was looking at the slide that we put up here just a little while ago, and I'm thinking, like, man, I wish I were there today. It was kind of what's your vision of retirement? I don't know if that's yours, or I don't even know if it's mine, but boy, it sure looked good for today. But it does represent retirement. And Jim, if we go to that next one, when we look at it, one of the things that we need to be sure to do, of course, and one of the things in the back of our mind is, how do we protect what it is that we want and make sure that retirement is a reality for us? Well, I think one of the easy ways to do that is to be sure that the income that our assets are generating is guaranteed income. And there are a number of different ways to do that. And something that I've done my entire career, but I think is extremely important and can be added into things like Social Security and into things like pensions. Looking at what the risks might be, the things that might cause this not to work out, taking a look at a thing called the sequence of returns. And my previous life, we used to call it the sequence of returns risk. And of course, that's kind of what it is. It's critical because if you take a person who is 65 years old as an example, that old retirement age that Andrew referred to, and you give them $1 million and you say, okay, you know what? You're going to live probably 30 years in retirement. And they'll, of course, argue with you and say, well, I won't live that long. I don't want to live that long till they're right there, and then they want to live that long. But 30 years is a long time, and certainly it's a long time to stretch out $1 million if you're withdrawing 5% a year that's indexed to inflation, which is what we're doing in this example. And the reason for that is that if you look back and take a look at a portfolio that at one point was 80% equities and 20% fixed income, or stocks and bonds, okay? Had you retired with that asset allocation in 1975, your money lasts 30 years, okay? Exactly what we were looking for. You're 95. The catch is that if you retired in 1974, you ran out of money in 1987, 13 years later. And of course, what happened was that the S&P 500 had a negative return of 26% in 1974, and you added to the issue by taking another 5% out. You just used up almost a third of your retirement capital. Sequence of returns was negative. That's why we have to be diligent. We have to look at things like guaranteed income because we don't know when these things are going to happen as much as we would like to. This slide comes from an article in the Wall Street Journal, 1999. And I've forgotten who actually did the study. They published it. T. Rowe Price has updated it periodically. Jim, you and I were talking about this the other day, and I've forgotten how many times it's been updated, but it's really pretty simple. You look at a 30-year retirement here, and along the left-hand side are withdrawal rates, 3 through 8%. Across the horizontal axis at the top is our asset allocations of 100% stocks, 0% bonds on the far left, all the way over to the far right of 20% stocks, 80% bonds. And then if you look at the intersection of those, if you said, okay, what if I, took 3% and a 60-40 allocation, 96% probability that this is all going to work out, which is great. 96%, I'll take it, right? The problem for a lot of folks is that a 3% withdrawal rate just isn't enough. What if we made it just 4? 4 would be $10,000 a year on $1 million, 60-40 allocation, 4% withdrawal, 80% chance of making it. Okay, that's a little dicey, but I'll take that. I mean, a pretty good chance. Let's take a look at that. Here's $1 million, 60-40 asset allocation, 4% withdrawal. That's $40,000 a year, right? 80% probability. We just covered that. Okay. What's the chance of failure? If it's 80% chance of making it, it's a 20% chance of failure. What can we do to mitigate that risk, that sequence of returns kind of risk? Well, if you, instead of putting the $1 million in a 60-40 stock bond allocation, you allocated the 60-40 piece, but only $500,000. And instead of even 4%, you did 3%. Now that would be $15,000 a year. But the beauty of that, if you recall from the previous slide, is that a 3% withdrawal in a 60-40 asset allocation gives you a 96% probability of success. We like that. That's a whole lot better than 80, right? But I only have $15,000. Well, what if we took the other $500,000, allocated that to either a variable annuity or a fixed index annuity with a guaranteed withdrawal benefit of 5%? Very doable. That would be income of $25,000 and a probability of success of 100%. Now, that's still $40,000, but doing the math, that's a 98% probability of success. And I'll tell you what, when you reduce failure from 20% to 2%, I'm not a mathematician, but that's better, right? So as you look at all of this, one of the things, and you saw it on the introduction slide where it said retirement income planning, and it had SIR out next to that. It didn't stand for SIR. It stood for Sustainable Income Ratio. And on all of our annual income plans, one of the things that we include is the Sustainable Income Ratio. That's made up of two parts. One is the total guaranteed of all of your guaranteed income sources. And, there could be others, but predominantly you were talking about Social Security, talking about pensions and annuity income, as I just mentioned. If we divide that by your total retirement income goal, we then have your sustainable income ratio. What do we know is going to happen? And if we can get that to a minimum, an absolute minimum of 80%, I think you can be pretty comfortable in meeting most of your retirement goals. If we can get it to 98%, obviously that would be even better. So with that, the idea here is, how do we make you comfortable in retirement? How do we build your sustainable income ratio to a 98% or an 80% minimum? That's how we do it.